Rain slicks the pavement outside the Federal Reserve Building. The camera focuses on a discarded newspaper tumbling across the asphalt. The headline blares, "Bitcoin crosses 100K." Financial pundits on CNBC are currently screaming about gold hitting $4,000 an ounce, framing it as the ultimate sanctuary. They want you focused on the shiny objects. It is a calculated diversion. While the retail crowd fights for scraps of digital code and yellow bars, a silent migration of capital is occurring. The 1% have stopped playing the game of appreciation. They have started playing the game of ownership. Public markets are currently facing a $7.6 trillion debt maturity wall. The FDIC's latest quarterly profile reveals hundreds of billions in unrealized losses sitting on bank balance sheets like unexploded ordnance. During the Roman debasement under Diocletian, the elite fled the crumbling denarius not for jewelry, but for the latifundia, massive, self-sustaining landed estates. Today, the ultra-wealthy are executing the same retreat. They aren't looking for returns in the 2025 fiscal year. Survival is the only dividend that matters when supply chains are brittle and the dollar's hegemony is questioned by the BIS. Wealth at the highest level has become forensic. It is no longer about owning land in a general sense. That is a trap for the uninformed. The move is into assets so specific that your average wealth manager lacks the vocabulary to describe them. We are talking about the capacity for survival. Billionaires are quietly acquiring three specific pillars of the new economy. First, farmland, but only those plots with specific geological traits that allow for recharge from deep aquifers. Second, senior water rights, legal claims dating back to the 1800s that supersede municipal needs during a state of emergency. Third, catastrophe bonds, a grim financial instrument that allows the elite to profit directly from the volatility of a changing climate. The public is being fed a narrative of digital gold to keep them occupied while the physical foundations of life are fenced off. In the coming collapse of purchasing power, having $1 million in a brokerage account will feel like holding a handful of sand. Real power is now measured in gallons per minute and acre-feet of soil. The gate is closing. If you are just now hearing about these assets, you are already on the outside looking in. A thick, leather-bound portfolio sits on a mahogany desk. A hand flips through topographical maps of the Pacific Northwest. We see the name Cascade Investment LLC stamped on a manila folder. The scale of what we are looking at is difficult to process. Bill Gates now controls 275,000 acres of American soil, a footprint spanning 430 square miles. This isn't just a portfolio. It is a private kingdom larger than the entire city of Los Angeles, carved out of 19 different states. While the 2024 headlines focused on his divorce or his philanthropic ventures in Africa, the Microsoft co-founder was quietly perfecting a domestic strategy of peak accumulation. He has become the largest private farmland owner in the United States, and he didn't do it by following the herd. This is precision buying. If you look at the geographic clustering, the logic reveals itself. He is obsessed with two specific regions, the Mississippi River Delta and the Columbia River Basin. These aren't just patches of dirt. They are the coordinates of the Triad of Value. To the elite investor, land is secondary. The triad consists of deep, silty loess soil that retains nutrients for decades, climate zones that support multiple growing seasons, and, most critically, absolute priority access to aquifers. In the Columbia River Basin, You aren't just buying acreage, you are buying the energy-efficient infrastructure of low-cost hydropower and the legal right to tap into one of the most reliable water systems on the planet. Consider the June 2025 transaction in Benton County, Washington. Gates's entities authorized a $131 million strike for roughly 8,000 acres in the Horse Heaven Hills region. He paid approximately $16,000 per acre, 4 times the national average for farmland. To a traditional farmer, the math looks insane. To a billionaire looking at the 50-year horizon, it is a bargain. He isn't paying for the corn or the potatoes currently in the ground. He is paying for the senior water rights and the mineral-rich volcanic soil that will remain productive when the rest of the world's breadbaskets are choked by dust. In a world of infinite digital currency, Gates is cornering the market on the finite physical inputs of human existence. He is building a moat made of dirt and water. A massive, glowing map of the United States dominates the wall. The investigator taps a touchscreen, and a sprawling, blue and yellow, amorphous shape bleeds across 8 states, from South Dakota down to the Texas Panhandle. This is the Ogallala Aquifer, a prehistoric underground sea containing enough water to flood the entire United States to a depth of 1.5 feet. It is the lifeblood of American agriculture, responsible for 30% of all U.S. irrigation. But focus on the colors. In the Texas and Kansas sectors, the map is bleeding red. Depletion there is a terminal diagnosis. It would take 6,000 years for those southern wells to refill naturally. While the headlines scream about a national water crisis, the billionaires are looking for the blue pockets. In Nebraska, the script flips. This is where the Ogallala is at its thickest, with saturated zones reaching up to 1,000 feet deep. More importantly, the soil here is porous, allowing for recharge rates that are 10 times higher than in the southern plains. Bill Gates's entities, like Mount Edna Farms, have quietly spent over $113 million here, amassing over 20,000 acres in 19 different counties. They haven't just bought land, they have positioned themselves over the deepest, most resilient part of the reservoir. This isn't an investment in next year's corn yield. It is a 100-year play. The Fed can print trillions of dollars, but it cannot manufacture a single gallon of Ice Age paleo water. By securing the land with the highest recharge potential, Gates is effectively banking the water. He is securing the only geologically stable food production zone left in the continental United States for the next century. While common investors chase 6% dividends, the 1% are looking at the 2026 climate reality. As the southern Ogallala hits a Dust Bowl tipping point, the value of a Nebraska acre with a stable water table won't just double, it will become a sovereign-level asset. They aren't buying the farm, they are buying the right to exist when the taps elsewhere are turned off. You are watching the privatization of the survival curve, one aquifer at a time. The financial system is designed to keep you in the dark, but history provides the map to escape the trap. If this insight opened your eyes, hit the like button to help us break through the noise. Share this with someone who needs to see the patterns before the next collapse, and subscribe to master the mechanics of wealth that they don't want you to understand. Don't let your purchasing power disappear in silence. Drop a comment below, and let's discuss the truth the 1% ignores. The air is thick with the scent of old paper and dust. The investigator pulls a heavy, yellowed ledger from a shelf labeled Property Records, 1880-1895. To understand the 1%'s obsession, you have to stop looking at the ground and start looking at the law. In the American West, there's a legal doctrine called prior appropriation. It is a brutal, binary system often summarized in 6 words. First in time, first in right. If your claim to the water on your land was filed in 1875 and the city of Phoenix filed theirs in 1950, you get every drop you need before they get a single ounce. During a drought, you are a god. They are a charity case. Billionaires aren't buying land to be farmers. They are buying land to become water lords. They are hunting for senior rights, the oldest, most bulletproof claims in the ledger. Take the legacy of T. Boone Pickens. He was the first to realize that while oil has substitutes, water has none. Pickens spent decades amassing 211,000 acre-feet of water rights in the Texas Panhandle. In a landmark deal, he turned that blue gold into a $103 million payday by selling the rights to the city of Amarillo. He proved that you don't need the land. You just need the permission to drain what's underneath it. The trap is being set right now. As the 2026 fiscal year approaches, water scarcity has been successfully rebranded as a financial product. Hedge funds and family offices are cornering these senior rights because they know that every new housing development, every server farm, and every municipal expansion needs their blessing to exist. They aren't just selling water. They are selling the permission to grow. This isn't a theory. It's a consolidation of power. When you own the water, you own the town, the industry, and the future. The 1% are quietly decoupling water from the land, turning a shared resource into a private bank account that pays out in gallons. While you worry about the price of gas, they are setting the price of your next glass of water. A digital ticker scrolls across the bottom of a transparent monitor. The air is sterile. Outside, the skyline is sharp, but inside, the focus is on a map of the San Joaquin Valley. While the public fights over plastic straws and low-flow showerheads, institutional giants and billionaire families have moved into the banking business. They aren't banking currency, they are banking molecules. Leading the charge is Water Asset Management, WMM, a firm that treats water not as a right, but as an underpriced commodity. Their strategy is a cold-blooded arbitrage. Buy farmland with senior rights, install high-tech efficiency systems to use less water on the crops, and then sell the saved water to thirsty, growing cities at a massive markup. To see this in action, you have to look at Stuart and Linda Resnick, the billionaire couple behind Fiji Water and Wonderful Pistachios. In 1994, during a series of secretive meetings at a Monterey resort, the Resnicks and a handful of other contractors essentially seized control of the Kern Water Bank, a 20,000-acre underground storage facility built with hundreds of millions of taxpayer dollars. Today, through their company Westside Mutual, the Resnicks control a 57% stake in that bank. It can hold nearly 500 billion gallons of water. While the 2025 droughts forced California towns to haul in bottled water for basic hygiene, the Resnicks had enough stored liquid capital to keep their 130,000 acres of almonds and pomegranates thriving. They took a public resource, privatized the storage, and turned it into the ultimate insurance policy for their empire. The competition for this control has reached a fever pitch. In early 2025, the investment world watched in silence as the Mormon Church, operating through its entity Farmland Reserve Inc., stepped onto the auction block in Washington state. They were up against Bill Gates's 100C LLC for the assets of the bankrupt Easterday Ranch. Gates bid $208 million. The church didn't flinch. They dropped $209 million in an all-cash deal to secure 20,500 acres. But look closer. The land was just the wrapper. The real prize was the slew of lucrative Columbia River water rights attached to it. By outbidding the world's most famous landholder, the church cemented its position as one of the largest private owners of water in the West. They are betting that in the 2026 fiscal regime, a senior water claim on the Columbia will be worth more than any tech stock in the world. This is the end game of private water banking. When the 1% control the storage and the senior rights, they control the cost of every shower you take and every vegetable you buy. They have turned a human necessity into a toll road for survival. Blue light from Bloomberg terminals reflects off the cold glass of a corner office. The room is silent, save for the hum of high-end HVAC. On a screen, a weather satellite tracks a low-pressure system forming off the coast of Africa. To a meteorologist, it's a storm. To the 1%, it's a trigger event. We are entering the world of insurance-linked securities, specifically Catastrophe Bonds, or CAT bonds. This is the ultimate obscure asset. While the retail market panics over interest rate hikes or quarterly earnings, the elite are trading the probability of destruction. They have found a way to turn hurricanes, earthquakes, and wildfires into a high-yield, non-correlated fixed income stream. Here is the mechanism. An insurance company needs to offload risk. They create a special purpose vehicle, SPV, a bankruptcy remote entity typically domiciled in Bermuda or the Cayman Islands. This SPV issues bonds to sophisticated investors. The capital from those investors is held in a secure trust, usually in U.S. Treasuries, acting as collateral. If no disaster hits, the investor collects a massive coupon. But if a trigger occurs, like a Category 5 hurricane hitting a specific coordinate, the principal is vaporized and sent instantly to the insurer to pay claims. The math is staggering. In 2024, the cat bond market delivered a record-breaking 17.4% return. Compare that to the S&P 500, which limped along at roughly 7% during the same period. By mid-2025, the market surged past $60 billion as the 1% fled the volatility of the traditional banking sector. They realized that while the Fed can manipulate interest rates, it cannot manipulate a tectonic plate. This is the power of correlation zero. Cat bonds are the ultimate hedge because they are fundamentally detached from the human economy. A stock market crash doesn't make a cyclone more likely. A trade war with China doesn't trigger an earthquake in Memphis. By moving billions into these instruments, the ultra-wealthy have decoupled their wealth from the fate of the US dollar. They aren't just betting on the weather. They are betting on the fact that the rest of the world is unprepared for it. They are charging the world a premium to watch the storm roll in. The glow of a television screen flickers against the wall. On the news, a red banner scrolls. S&P 500 plummets as tariff shock hits global markets. The investigator sits in the shadow, a glass of water sweating on the table. While the tariff shock of April 2025 sent retail portfolios into a tailspin, a different kind of silence settled over the offices of firms like Fermat Capital and Stone Ridge. Most investors saw a 15% drawdown in their retirement accounts. They watched trillions in market value evaporate in a single weekend as the debt maturity wall finally crumbled. But if you looked at the ledgers for catastrophe bonds, the line didn't just hold, it was up 1%. This is the beauty of correlation zero. A hurricane in the Gulf of Mexico doesn't care about trade wars with Europe. A wildfire in the Sierra Nevadas isn't impacted by a tech stock sell-off. In the first half of 2025, while the world was panicking, the cat bond market was absorbing nearly $17 billion in new issuances. It has become the only green light on the screen for those who can afford the entry fee. The play has evolved. It's no longer just about Florida hurricanes. The 1% are now diversifying across a menu of global destruction. We're talking about wildfire bonds, triggered by specific heat maps in Los Angeles, flood bonds, tied to river levels in Central Europe, and even pandemic mortality bonds that pay out based on actuarial death rates. The sophisticated players, the ones managing the billions, are firms like Fermat Capital, which now oversees nearly $10 billion in these strategies, and Stone Ridge, which pushed its mutual cat bond assets over the $5 billion mark this year. They are the new reinsurers of last resort. They aren't just betting on the weather, they are betting on the fact that the traditional financial system is too fragile to handle the next century. While you wait for a market rebound, they are harvesting the yield from the world's most predictable volatility. The sun is a bruised purple on the horizon. The investigator walks alongside a line of rusted hopper cars, the crunch of gravel under his boots the only sound. He stops, looking at a decaying factory in the distance. We've spent the last 20 minutes tracing the money trail from the aquifers of Nebraska to the high-stakes trading floors of Connecticut. On the surface, Farmland, water rights, and catastrophe bonds look like a disjointed portfolio. Your average financial advisor would call this aggressive diversification. They would be wrong. This isn't diversification. This is a deliberate, coordinated withdrawal from the fiat experiment. The 1% are looking at a set of data points that the Federal Reserve doesn't put in its press releases. They are looking at the $34 trillion national debt and the looming interest payments that now exceed the entire defense budget. They see the 2025 FDIC reports showing $517 billion in unrealized losses sitting in the banking system like a tectonic fault line ready to slip. Historically, when empires reach this level of debasement, think the late Roman solidus or the Weimar Papiermark, the elite don't wait for the currency to hit zero. They move into the essentials. These three assets share a chilling commonality. They are immune to the printing press. You can create 10 trillion digital dollars with a keystroke, but you cannot manifest a single acre of topsoil or a gallon of potable water. These are the hard stops of human civilization. By cornering these markets, the ultra-wealthy are effectively shorting the future of the American middle class. They are betting that the social contract, the idea that your bank balance represents a stable claim on reality, is about to be torn up. This is the civilization hedge. While the public is encouraged to buy the dip in tech stocks or park their savings in high-yield digital accounts, the 1% are building a parallel economy. In this new world, wealth isn't measured in digits on a screen. It's measured in capacity. The capacity to feed your family, the capacity to stay hydrated, and the capacity to remain solvent when a weather event wipes out an entire zip code. They have stopped playing for profit and started playing for permanence. They are buying the bridge while everyone else is still arguing about the toll. If you aren't holding something physical, something essential, and something scarce, You aren't an investor in the 2026 economy. You're a passenger on a ship that's run out of fuel. The camera pulls back from a cluttered desk. A single laptop is open, displaying a brokerage account. The investigator's voice is lower now, more intimate. We are no longer looking at what they have. We are looking at what you can get. The gate to the billionaire class is heavy, but it isn't locked. You don't need a $200 million all-cash bid to start positioning yourself for the 2026 reality. The ultra-wealthy want you to believe these assets are inaccessible, that you are stuck with the volatility of the S&P 500 or the hype cycles of crypto. But the capacity for survival can be bought in increments. If you want to follow Bill Gates into the soil, you look at Farmland REITs. Farmland Partners, FPI, and Gladstone Land, are the two primary vehicles for the retail investor. For the price of a single share, currently trading around $10 for FPI, you become a fractional owner of thousands of acres of prime U.S. cropland. As of early 2026, these REITs have become a vital refuge. While traditional real estate is reeling from high interest rates, farmland has maintained its historic 10.2% annual return profile. You aren't driving the tractor, but you are collecting the rent from the farmers who do. Accessing the blue gold of senior water rights is more complex, but the infrastructure of that scarcity is tradable. You look at the water utilities sector. Companies like American Waterworks, AWK, and Xylem XYL. These aren't just utility stocks. They are the gatekeepers of the 40% supply-demand gap projected for 2030. In January 2026, AWK is trading with a median price target of $154, reflecting a 13% upside as municipalities are forced to hike rates to cover the cost of aging pipes and PFAS contamination. You aren't owning the aquifer, but you are owning the toll booth that every gallon must pass through. The most difficult door to open is the one to catastrophe bonds. Historically, these were accredited-only secrets, but the wall is cracking. Mutual funds like the Stone Ridge High Yield Reinsurance Risk Premium Fund, HRX, or the Pioneer ILS Interval Fund have lowered the barrier. While some still require high minimums, many platforms now allow entry for as little as $1,000 to $2,000. As we saw in the 2025 meltdown, these funds provided the only correlation zero sanctuary. They aren't without risk. If a trigger event occurs, your principal can take a hit. But in a world where the FDIC is warning of $500 billion in unrealized bank losses, a 9 to 10% yield tied to a hurricane instead of a bank failure starts to look like the most rational move on the board. You are finally playing the same game as the family offices in Greenwich. The door is ajar. The question is whether you'll step through before the 1% finishes the sweep. The investigator stands at the edge of a rugged cliff. The ocean below is a churning gray. The waves crashing against the jagged rocks with a rhythmic, indifferent violence. He is silhouetted against a sky that is fading from deep orange to a cold, bruised charcoal. We've traveled from the hidden water banks of California to the algorithm-driven disaster markets of Wall Street. Along the way, the image should have become clear. What we are witnessing is not a series of disconnected investments. It is a fundamental reconfiguration of what it means to be wealthy. For the last 50 years, wealth was about growth, about seeing a number on a screen move from left to right. But as we navigate the uncertainties of 2026, the elite have recognized a different reality. They have stopped chasing the 5% annual return and started building a civilization hedge. This is about regime change survival. The 1% are looking at a global landscape defined by controlled disorder, an era where governments are struggling under the weight of $34 trillion in debt, where supply chains are being weaponized, and where the climate is the most volatile player in the market. They are moving their capital out of the ghost economy of derivatives and into the real economy of human requirements. They are buying the bridge while the crowd is still arguing about the toll. The pattern is right in front of us, hidden in plain sight. It's written in the deed of a Nebraska farm, coded into a catastrophe bond, and locked behind the senior water rights of a 19th century land claim. The lesson is simple, yet most will ignore it until it is too late. The person who controls food, water, and risk transfer will be wealthier than the person who owns stocks in a currency that no longer functions. Your move is to stop listening to the noise of the popular assets, the ones the media uses to keep the retail crowd occupied. Start observing the patterns of those who have the most to lose. Position yourself for the reality of 2030 and beyond. This isn't just about your bank account. It's about your place in the architecture of the future. The gate is closing, and the 1% have already made their move. The question is, what are you holding when the music stops? The financial system is designed to keep you in the dark, but history provides the map to escape the trap. If this insight opened your eyes, hit the like button to help us break through the noise. Share this with someone who needs to see the patterns before the next collapse, and subscribe to master the mechanics of wealth that they don't want you to understand. Don't let your purchasing power disappear in silence. Drop a comment below, and let's discuss the truth the 1% ignores.